Okay, guys, can you hear me? Okay, so thanks a lot, first of all, to the organizers for providing this very nice platform to share ideas, to share our life experiences. I think it's a wonderful opportunity. What they say, sharing is caring, so thanks a lot for caring about us and giving us the opportunity to care for each other. So I'm gonna, with my talk, bring us a little bit back to the topics of financial stability and systemic risk, the ones that were touched by Diana on the first presentation. So as you can probably see from the title of this talk, I'm gonna talk about liquid bonds and fire sales, and I'm gonna talk about their dark side. So there is obviously a fan of Star Wars on the team. Among the three of us, that's not me, let me admit that honestly. But I'm a big fan of the research that I'm doing. So, if you ask Google what is wrong with finance today, it will suggest an answer from Economist, quoting Timothy Geithner saying that fire sales contributed to the financial crisis by exaggerating fundamental shocks. And we actually didn't understand the extent to which this is happening. Wall Street Journal quoting Gary Gorton lends support to this idea that fire sales exaggerate fundamental shocks, and they were a contributing force to the severity of the financial crisis. With my paper, I want to extend our understanding how fire sales exaggerate fundamental losses, how they contribute to the severity of the shocks that the system is hit with. And I'm going to look at one particular aspect of that, which is what assets do institutions hit with a fire sale are selling, and how that endogenous choice of which assets to liquidate in fire sales affects price and losses that happen in fire sales. Okay? So I'm going to look at endogenous liquidation strategy of affected institutions. When I'm talking about fire sales, what scenarios do I have in mind? So for example, banks selling financial assets as part of the deleveraging process. Okay? Hedge funds or mutual funds liquidating assets to satisfy withdrawals. Or property and casualty insurance companies selling assets to satisfy claims on natural catastrophes. This would be the focus of my talk today because of the data availability. But what I'm going to talk today is going to apply more generally, also to asset managers and to banks. What is common in all these scenarios is that there is a group of financial institutions hit with a series of correlated liquidity shocks. So what does it mean? It means that some institutions are affected at the same time. They at the same time need money for the reasons that might be exogenous to the things that they invested in. So correlated liquidity shocks means that those institutions are affected at the same time. And they need to raise some funds on a short notice. Okay? So the natural question arises, so how should they do that to minimize the losses? The current literature takes a stand that the optimal liquidation strategy is the one of a fixed proportion. So suppose I have two assets, and the idea that the current literature promotes is that you sell, say, 20% of that asset and 20% of the other asset. This idea has some empirical support in the literature on equity mutual funds, how equity mutual funds manage withdrawals on a monthly basis. So you need to understand that the data availability in the mutual fund industry is limited to monthly observations. Okay? So it seems to be the case that this liquidation strategy, fixed proportion of assets, has a lot of support in mutual funds on a monthly basis in equity, those that invest in equity. So what I'm going to argue is that while it might have some support in equity, it is completely inadequate to address the way financial institutions choose which assets to sell in fire sales. Well, those assets are less liquid than equities. So what I observe in my data is that property and casualty insurance companies, in fact, sell only 3 out of 100 bonds that they have. So I focus on corporate bonds, but that more generally applies to municipals and treasuries that they have. So what does it mean? It means that they do not go 20% down on every bond out of 100 that they hold. They actually choose to sell only 3 out of 100. And those are more liquid bonds. Okay? So they pick 3 liquid bonds to sell, and these are the only assets that they will sell during the fire sale. So, however, what I mean by liquid bonds is actually when I look at 2 weeks prior to the beginning of the fire sale window, and I sort the bonds on the liquidity measures 180 days prior to even that date. So it's kind of pre-fire sale liquidity. Okay? So when I sort them on that liquidity and look at the realized price impacts after the fire sale, I observed that those 3 liquid bonds that were sold during fire sale exhibit larger price impacts during the fire sale. Okay? So those things that were trading in very liquid markets before fire sales end up having really large price impact, so like huge trading losses during fire sales. And actually, we are not even the first ones to document that, because this was documented before in the market for sovereign bonds, and some suggestive evidence was also in the market for corporate bonds. Okay? So what the contribution of our paper would be to revisit that and see, well, do the insurance companies act strategically, or are they just dumb and stupid and don't understand what they're doing? Couldn't they find another bonds to sell that have smaller price impacts and smaller trading costs? So the question that we would like to address is, can this evidence be consistent with a rational explanation? Or is it a clear indication that insurance companies miss something and they don't understand something and they act irrational? Okay? So the answer is yes, there is a rational explanation that is consistent with these findings. And the story that I would like to tell you is that of a lack of commitment. We think this is the reason why we observe this large price impact. So here's the story. During a fire sale, obviously, the price impacts that we observe in assets depend not only on what I sell, but also what other companies affected sell. Okay? So, which means that I need to look at what other institutions are selling. If my assets do not overlap with anybody else's assets, we're not going to affect each other. Okay? So the crucial thing happens is that there is some overlap in the assets. We call it commonality. Some bonds are more common than others. So some bonds may be held by me as a financial institution, by René, by other participants, while other bonds I will hold only on my own. This would be less commonly held bonds, and bonds that everyone in the room will hold will be common bonds. Okay? So what happens with the commonality? When I sell that bond, I exert a negative externality on all the other sellers of that bond. Just like in a Cournot equilibrium, right, we tend to oversell the quantity relative to monopoly equilibrium because we do not internalize the negative impact that me selling that bond has on the revenue of everyone else. Okay? So just like in a Cournot equilibrium, we sell more than in a monopoly equilibrium, commonly held assets tend to be oversold in a fire sale. Oversold relative to assets that are separately held. Okay? So there's this negative externality that we don't internalize. And that's the reason why I sell too many of the common bonds. There is one particular feature of the corporate bond market that we need to be aware of, is that there are very few liquid bonds. And so when I talk about them selling 3 liquid bonds, these are actually commonly held bonds, because there are that many of them, and they end up being commonly held. Okay? And so what happens is that when I look at liquid bonds, I actually also proxy for common bonds. Okay? And so once we control for the commonality, this relationship, this seemingly positive relationship between price impacts and liquidity actually disappears. Okay? So we can explain this seemingly positive relationship by saying that this is actually common bonds, and that's why they are oversold relative to the first best. Okay? So I will walk you through a simple model just to fix a few ideas, and then I will show you 2 regression tables to convince you that the idea that I have in mind actually makes sense in data. Okay, so what, in terms of the model, what do I need to fix the ideas? Well, I need to kind of construct an example and to illustrate that if there are two insurance companies that act strategically in a sense that as if they are integrated insurance company, there would be the first best outcome versus a Nash equilibrium outcome when they act in their first interest, in their best interest. So we work with some price impact functions, which are not really that important. It works with almost any price impact function that makes sense. And we minimize price impact subject to the constraint that I need to raise some money. Okay. So how is the equilibrium in the market? How do I decide which bonds to sell? There are 3 bonds, and one of the bonds, bond A, is commonly held. Bonds B and C are separately held. How do I decide which bonds to sell? Well, if I'm a rational firm, I'm going to equalize marginal losses on each of the bonds sold. If I'm an integrated insurance company, I'm going to internalize the negative impact on the price of the bonds that selling of both by firm 1 and firm 2 of the bond A has. So it's sort of like a monopoly outcome. If I compare that to the lack of commitment or the Nash equilibrium, I'm going to do exactly the same, but I'm going to ignore the fact that there is another company selling the same asset. Okay? So I'm going to ignore the fact that when I sell extra items, it's not only my revenue that's extra bonds, it's only my revenue that suffers, but also your revenue that suffers. Okay? And so what it means is that I will sell more of the commonly held asset. Okay? Now, what does the equilibrium imply? The equilibrium implies that if I have more liquid assets, I sell proportionally more of those assets up until the average price impacts equalize. This is in the first best. So I sell so that each asset has a 2% price drop. In the Nash equilibrium, on the other hand, what happens is that I oversell the assets that are common, and therefore they have a larger price impact, which means that even if the asset A was liquid, I would have a larger price impact on that asset. Okay? So, equipped with this idea, we go back to the notion of the OTC markets, where the corporate bonds are traded, and realize that there is typically a minimum quantity with which the insurance companies are trading with the dealers. And so what it implies is that there would be a minimum selling quantity. Means that I'm not going to be, if I have 100 of bonds, I'm not going to be selling each and single one of them. I will have to choose a few bonds to sell. And which one of them will be? I will try to sell liquid and least common. So I'll try to find some bonds that are liquid, the most liquid, and least common. So these are the ideas that we're going to take to data. So when I'm going to the data, I have 2 empirical goals. I want to establish that natural catastrophes indeed created fire sales in the corporate bond market. Okay? There is some other previous literature that has documented that. So we will just reestablish the fact using our data. Now, the second thing is the unique part to our analysis. What we're going to do is we're going to revisit the relationship between prior bond liquidity and asset prices, controlling for commonality of bonds. And we're going to see if the relationship flips the sign, if it preserves or if it stays the same. So that's the second objective. Okay? So speaking of liquidity of bonds, this is where I measure liquidity using trading volume. Main results go through if I use price measures, which are a bit more messy, but it still goes through. Okay? So what about liquidity? So the most liquid bonds, the 1% of the most liquid bonds by number, accounts for about 76% of the trading volume. So the distribution is extremely skewed. There are very few very liquid bonds, and there is a huge universe of highly liquid bonds. What about commonality? And liquidity, so which bonds do they sell? So commonality of holding means I just count the number of companies that hold that bond, okay, among the affected companies. So if I go from quantile 1 to quantile 5, I move from the bonds that are held by a few insurance companies to the bonds that are held by many insurance companies. Okay? And liquidity is obviously very liquid bonds to very liquid bonds. You can see that the bonds that are sold are mostly liquid and common, despite the fact that they would like to sell less common bonds. There are just none of them. This is what they would like to sell. So this is if I divide the selling by the holding volume. If there are any unicorn bonds that are least common and most liquid, these are the bonds that these insurance companies love to sell. Okay. Regression evidence. So the first question, was there indeed a fire sale? The answer is affected companies were more likely to sell bonds. So this is probability of the bond being sold. Yes. The coefficient is positive, which means that affected companies were indeed experiencing the need to raise money, and to do that, they were selling bonds. So affected companies, everything else equal, were more likely to sell corporate bonds during the fire sale window. And the price impacts, this is the regression. The first column is this puzzling relationship that I started with. Okay? So log by volume is our preferred liquidity measure, measured before the onset of the fire sale, or 180 days. So more liquid bonds had larger price drops in fire sales. Okay? That's the seemingly puzzling evidence that we started with. However, once I control for commonality, we have two commonality measures necessary to control for potential and realized commonality. So once I control for this commonality, this relationship disappears. Okay? So it's no longer the case that the bonds that were liquid before the fire sale are now experiencing larger price impacts. So what we conclude from this, what's the takeaway message from this from us, is that insurance companies tend to sell liquid bonds during fire sales. However, there are very few liquid bonds out there. So they tend to sell common liquid bonds. And this leads to overcrowding of these liquid markets, which leads price impacts lower and creates losses. You might say, okay, that's nice and interesting, so what's my takeaway message from that? How does that connect to systemic liquidity? Who should care about this result? I mean, beyond me, when I find it really fascinating. So we have an implication for measuring systemic risk. Okay? So obviously, the larger are the losses in fire sales, the more are there distortions in the system, because the price mechanism that allocates capital within the system will be distorted to a larger extent. Okay? So what we argue is that if the overlap or the commonality is in those liquid bonds that are going to be sold, the fire sale is going to be more damaging. Okay? This is in contrast to what has been proposed in the literature before. For example, the papers that I started with, the fire sale cascades, the ones that are based on the assumption that I sell a fixed proportion. They say, okay, no, the danger is not in the liquid bonds. The danger is in the overlap of the illiquid bonds. Okay? So we argue that's the opposite. Why? Because if you have an overlap in the liquid bonds, it's like a gun on the wall that never fires. Okay? So you don't sell that during the fire sale. So what we propose is to put higher weights on the overlap in the liquid assets. Okay? So in measuring the potential danger that is in the system. And of course, speaking of the recent trends in the regulation, we encourage not to kind of, when pressing for a higher liquidity of assets, to keep in mind that it might imply an increase in commonality of assets. So unintended negative consequence. Okay, so let me conclude. If there's one message I want you to take away from my presentation, it's that in the fire sales, insurance companies tend to sell 3 out of 100 bonds. These are mostly liquid, they exhibit larger price impacts, but it can be rationalized because they're common. So I do not find evidence that insurance companies act irrationally. Okay. And the danger, I think, is in the commonality of liquid bonds. So they can exaggerate fire sale losses. Thank you so much for your attention, and I'm looking for the comments.
Thanks so much, Maria. So now a word to Vidhi Chhaochharia from University of Miami with her discussion on this paper.
Can you hear me now? Okay. So thank you very much for including me as a part of this program. I'm a fan of your research as well. So I must say this is kind of very different from the kind of work I do, but I really learned a lot by reading this paper, and then in trying to discuss this paper, I read a lot around this literature, so thank you for that. I got to learn a lot about this thing. So the literature on fire sale is a very long and old literature, almost where the emphasis on what assets should be fire sold and what the price impact of that should be has been something that researchers, academics, policymakers have been interested in a long time, for a very long time. And I believe that the setting that Maria presented really well is almost the perfect empirical setting to actually examine this question. So of course she did a great run through of the results, but let me just kind of give you an overview of why I see this as a kind of almost a perfect empirical setting. So the focus is on insurance companies and corporate bonds. As she pointed out, there are only very few liquid bonds, and I'll come to the common ownership in a second, which imply that, of course, fire sales should have a large impact. So if you really want to isolate what the impact of fire sale have on asset prices, this is really the perfect empirical setting. And events in her setting are natural disasters, and I'll try and add a little bit to this, but that basically where the shocks are faced by all insurance companies, where they might have to liquidate. Her natural disasters currently, at least in the draft I saw, were mostly hurricanes. And I'll talk a little bit more about is there a way to actually increase the event setting in the setting that you already have. So one of the big takeaways from the paper, as I see it, and I think even Maria was trying to get you to the point, is this difference between commonality and liquidity. So I'm not going to re-point out her results a lot, or rather the fact that when you have these commonly held bonds and they are fire sold, the impact of the impact of liquidity on price kind of goes away. So a lot of it is coming from the commonality of ownership. And the paper does a very good job in trying to distinguish, or rather kind of suggest what common ownership means versus liquidity. But I really would like to understand, so not being an asset pricing person, or kind of, are we really talking about the same thing? Because if you talk to asset prices in general, liquidity and common ownership is not the same thing. And I would like to add another dimension to this, which kind of stems from all this network literature that we see today, is network centrality. So like she pointed out, this corporate bond market, especially the ownership of these corporate bonds by the insurance companies, is a really small, illiquid market where only few bonds are owned by everybody. Which means that it has to be the case that there is a common network effect of this ownership. This common network effect cannot be restricted only to insurance companies. this has kind of, if you look at mutual funds, if you look at any other of the big other institutions in the market, they too would be only holding these very few liquid bonds. And if there is any kind of liquidation pressure, this is going to impact all of them. Which means related to this common ownership and common liquidity is really about which of these assets are central to the network. And I mean, I'm not sure whether this is really material for another paper, or this is really just kind of understanding what. So all of these to me look synonymous in your paper. Network centrality, ownership, and liquidity. And I'm not sure whether that's really the case. So in relation to this network thing, I would really like to understand the ownership structure of these corporate bonds. And I understand that the monthly data does not give you that traction, but the Emacs, as again, being an outsider to this field, I do understand that Emacs requires you to voluntarily disclose what you hold. But to the extent possible, like from what I've read in the literature, it is possible to get a fairly good picture of the ownership structure of these corporate bonds in general. Maybe it would be interesting to see where exactly does this price pressure originate and how does it propagate. If these insurance companies are facing kind of these fire sale pressures, maybe there are other institutions who are facing similar pressures, or it could make for a more complete analysis of where really you want to go with this. So, and added to this, if you kind of slap on this, in the case of the insurance companies, there are severe regulatory requirements as to what they can hold. In terms of, for example, from my understanding of reading the Nike's website, there are these risk categories, and there are capital requirements based on these risk categories, which means they really, this common ownership is a very severe problem given the regulatory environment that these insurance companies are sitting in. And then, kind of to take it to the next step, if you're really talking about some assets that are central to the network or are commonly held by everyone, do these have an impact on other institutions as well? So when the insurance companies are offloading these assets, do you see an impact on other mutual funds or other institutions, other asset holders? Because given the way this market is structured and it's so thin, I would find it very hard to imagine that you're not going to see this cascading kind of effect. Maybe in your case, you're going to be able to find even stronger impacts on the pricing side if one takes all of this into account. My next broad set of comments is with regards to the portfolio. So, when you start reading the paper and the way you even present the results, one of the things that I really got excited about is that what assets are they going to fire sale first, or what assets are going to be offloaded. But when you read the paper and you kind of dig deeper, that's not very clear to me whether you really are answering that question. So I think, a lot of it is to kind of give your results a portfolio view of the fire sale. So in the sense that you want to know why is it that these corporate bonds are going to be offloaded first in the first place. So what else is in this portfolio? You guys do a great job of describing this in the summary statistics, but that's where it's left at. So what other assets could be fire sold? Do we see any patterns? Would the corporate bonds really be the first to be offloaded when these institutions are hit, or rather when these insurance companies are hit with a fire sale? And within the different bond categories, which I think you alluded to, that treasuries and munis would be sold first. And that would be obvious, right? Because that's going to generate the least, I think, at least for treasuries, that would be something that would be the most easy to offer. But there is an issue there, because insurance companies again face very strict regulatory requirements, which means they must have safe asset holding requirements. And if they do have safe asset holding requirements, they have to offload these bonds, corporate bonds first. So it seems to me that I would like to understand a little more as to how these couple of things relate. The regulatory requirements, why we believe that the corporate bonds would be the ones to be offloaded, and how do they relate to the other assets that are in the portfolio. And kind of to sum up this portfolio view of the paper, and I think it really would add, you have a great setting, great question. You guys really make, great headway with this, but I just would like to have a more complete picture. It could be just more descriptive if required, but at least the current read of the paper, it's not quite, I don't get a complete picture of what your constraints are and why insurance companies would choose to liquidate these corporate bonds. So it could be just a matter of discussion in the paper, but I would like to see what exactly and why are these assets being offloaded. The other thing that I was thinking about was right now the event set, of course, catastrophes are great. They give you these big impacts. These are P&C insurance companies. So I live in Miami, so who knows better? But I was kind of thinking about when I was reading some of this research around this paper, it seems to be the case that these insurance companies can only invest in certain types of bonds. So in terms of the ratings of these bonds. And they also have specific capital requirements in terms of which ones they can invest in. So if you're investing in something Nike's less than 2 or something like that, then you have a 20% capital requirement, as I understand. And maybe as additional events or maybe more can be done around these ratings, because you really have these borders, right? And to look at the borders of these ratings and see whether more constrained versus less constrained insurance companies behave differently. I think there is a set of rich cross-sectional implications that could add to the breadth of the paper that you already, it's already great, but it could add more to the breadth of the paper. And so, kind of exploiting these boundaries at where these capital requirements suddenly increase for these insurance companies, I feel is a really interesting setting. Now, whether that is a setting for another paper, I leave for you to decide, but for me, I feel that was very underexplored in this paper. You control for ratings and downgrades, but I would have liked to see more done around when the regulatory requirements change around these. So walking along these borders would be something that I would like to have seen a little more. And lastly, to conclude, as I said, I really, really enjoyed reading this paper because I learned a lot. The one thing that I would like to kind of push you towards, and I think you discussed really well in your presentation, I think the paper needs to go one more step forward, is how do you view this from a regulatory point of view? So, of course, these have, I would like to understand, or rather, you ended really well for the presentation as to there's a policy implication of for these commonly held bonds, especially for these insurance companies. I would have liked you to see that in the paper as well, as to the commonality and its implication from a regulatory point of view. I think some focus on what are the main reasons as to why these corporate bonds are liquidated, some discussion of that. It would be really helpful for the reader. And lastly, what are the implications of this for the market as a whole? So whether it's other institutions which will experience the same kind of price impact, or because these are commonly held corporate bonds by everybody, that seems to be kind of missing from at least the current version of the draft. But all in all, thanks a lot. It was a great read.
Thanks so much, Vidhi. Maria, would you like to respond?
Okay, can you hear me? Yeah, okay. So thank you so much, Vidhi, for the wonderful comments, and I really appreciate that you gave it so much thought, and it's really great to see how it reads to you and how what kind of thoughts it brings, and it clearly shows me where I'm not clear and where I can kind of improve, definitely. So a few things about the those comments that I can address now, and I put some of those on my to-do list. So those that I can address now. So what is the relationship between liquidity and commonality? Okay, so I think I wasn't very clear about that. So when I define commonality, I define it among the companies, insurance companies, or P&C insurance companies, essentially, right? So when I define liquidity, I bring in data on all the market participants, right? So if you think about data sets, right? The commonality is among NAC data, just property and casualty insurance companies. The liquidity is from Trace Universe, where all the market participants are selling and buying, right? So the bond could be liquid, but not commonly held, because it's being actively traded by mutual funds, or some hedge funds love it and trade it all the time, while property and casualty insurance companies stay away from it. And so that, if you might remember, there was this corner, and I call this, what are these unicorn bonds? So one, for example, is General Electric back in 2005 had one of these bonds that was super liquid because everybody else was trading it, but insurance companies had, only few insurance companies were holding it, okay? So it could be that the bond could be liquid because of the other market participants actively trading that bond, but not very common. So in that sense, yes, I think we need to make the point more clear. So to what extent, to what extent does it maybe what we can learn by bringing more market participants in, right? So suppose we could get that. So we have daily holding data, right? Suppose we say, okay, we give up on this kind of super detailed data and go to mutual funds and agree with having monthly data. Okay, we settle for monthly data. To what extent can we learn something more? So again, I would say that the same bond would have a different notion of commonality depending on the institutions that we are talking about. Okay, so it might have the same liquidity measure, but it might have commonality with respect to insurance companies, commonality with respect to certain mutual funds, and so on. And so in that sense, I think it would be an interesting analysis that could be done to see what are the different commonality measures depending on other institutions. Yeah. Speaking of so price impacts, I rushed through it when I realized that I don't have much time. We actually do look at how at two different price impact measures. One is insurance company specific related, so only at the transactions where the insurance companies are selling, so it's insurance company specific, and the other ones is general market price impacts. And so in that extent, we kind of look at first where it originates, when the insurance companies are selling, and then we look also at the overall market, kind of all the trace transactions, what are the price impacts there. So in that sense, I think we kind of can pinpoint that it starts here and goes there, and it takes about 30 weeks to go back, so it lasts. So in that sense, I think it's a great point how I think it puts my own ideas into very good perspective. So thanks a lot for that question. What are the portfolio view? Yes. So why I was not nodding about treasuries? They actually buy treasuries during that time, because yeah.
Something that is interesting. Why are they selling the assets they're selling, and why are they not selling? What are the patterns?
Exactly. So to me, so I kind of struggled with streamlining the paper and making it kind of one point. So we wanted to kind of, I have all these statistics at the back of like the internet appendix that never made it to the paper. Yeah, so they do sell everything a little bit on the assets. We do not study other bonds because of lack of the data. So I have the FISD for corporates, not for mutuals, unfortunately. So I cannot do the same stuff with other bond classes, but there are similar things happening in these subclasses, except for treasuries, where they stockpile the cash there so that they will pay out stuff. So the treasuries is the only thing that they do not sell. So in a way, we are looking at a representative asset class, yeah. And ratings, it has been already done. So there is a wonderful paper. So, but I need to reference it better, I think, in the paper. Yeah, and thanks a lot for pointing out that the policy implications are not that clear in the paper. I think they deserve a bit more of a central place. So thanks a lot. We are revising it right now, so I'm really happy for the feedback. Thanks a lot. So if you guys have any questions, I would be happy to answer them now or in the break, whichever.
Diane, yes?
Well, thanks, Maria. Is it working? Yeah. Fascinating work, really. So I have one question and one comment. Actually, my question is more like about what is the collateral story behind this? Is there, if there is one, because these are liquid bonds, they are usually used as collateral for example, repurchase agreements. And in the period of fire sales, banks have, or financial institutions have troubles renewing this contract, so they would get rid of the collateral. And then my comment is that I think your data is before the crisis, or am I wrong?
Including crisis.
Including crisis, but I think that this is going even. Your results are going to be even stronger now after the crisis, because banks are even more constrained than before the crisis, meaning that the set of investment possibilities and profitable investments is reducing. They're ending up being even more similar. And what I would think is that the correlation between liquidity and commonality is actually increasing because of regulation. And then in terms of implications and regulatory implications, what I would think is that you want to make capital charges basically a function of the price impact, or something that would be tailor-made at the institution level, knowing the systemic impact of financial institution. Well, in general, I find this very interesting.
Thanks a lot, Dan. Yeah, so I didn't think about the collateral. This is the first time I hear this point. I think it's interesting. I'll look into this. So I think it might be yet another reason why they're selling these ones. We control for all the bond characteristics that we could think about, as well as all the insurance company characteristics that we could think about. So, but could it be the case that this is the reason why they choose to sell these liquid bonds? It could be, yeah. So, I don't think that having the information that I have in my head right now, I can rule out that explanation.
That may be also one of the reasons why they're common in first place, because all institutions are using them as collateral. They are the one that accepted as collateral in the repo
Something
markets.
that contributes their liquidity and yeah. So the second point was about what changed after the crisis in terms of commonality and liquidity, right? So we see that the insurance companies are stockpiling corporate bonds, so they increase their investment in corporate bonds dramatically in dollar value, and we see that the commonality of the least liquid bonds is increasing. So we have this analysis. So my point is the following. So if I would have seen an increase in the commonality of liquid bonds increasing, I would have sounded an alarm. I would have said, okay, the systemic risk in the system is increasing. So in that sense, because it's got the commonality of the least liquid bonds that actually are not sold in the fire sale is increasing, so I'm less worried about that. And I completely agree with you that the risk weights, or the kind of the penalty weights, need to be tailor-made to the particular institution, given the business model that it runs. What kind of physical shocks, like physical in the sense of economic shocks that affect this one and others, this has to take that into account. So yeah, thank you so much.
Okay.